Hi, this short screencast is going to cover some of the terminology used in share investments. When you first start this course, there might be a whole lot of words and terms used that you don't quite understand. So I've compiled a list of some of the key ones that we used with a short explanation. This is not a definitive list, but it's a good thing to keep you going. So let's have a look at some of the things that we're covering. The first one is obviously shares. When you buy shares, you become a part owner of the company. So you have a share in that company. So if there's 1,000 shares and you buy one share, you'll have a 1,000th ownership of the company, which means that you have the ability to vote at general elections or general meetings and be able to have your say in which way the direction of the company goes. Obviously, the more shares you own, the more ability you have to inform and control the voting. If you own more than 50% of the shares, then it's said that you actually own the company. There are two types of shares that we have. The first one is ordinary shares. These are the most common type of share that you can buy. You become part owner in the company. They are relatively cheap to buy and you might receive dividends. The other types of shares are preference shares. These are a bit more expensive, a bit harder to get hold of, and they rank before ordinary shares when dividends are paid. And we'll talk about dividends in a bit. So they have a fixed dividend rate. You get paid before the ordinary shareholders and they're a bit more expensive to buy. This is a safe option, and some people have a blend of ordinary shares and preference shares in their portfolio. When you buy shares, you pay a brokerage. When you sell shares, you pay a brokerage. The brokerage is a fee that goes to a broker or a broking company for the trading of shares. The break-even price is the price that you would like your shares to rise to so you don't make a loss. Doesn't mean you make a massive profit, but it's the break-even price. So once the shares get above this price, you start making a profit. It's very handy to know this. The yield is the return that you get on those shares, and it's expressed as a percentage. So if you're getting a 10% yield, that means you're getting 10% back on the shares that you invested. So if you've got $1, if your shares are worth $1, and you get a 10% yield, that means you're getting 10 cents back for every dollar you invest. Now, the yield is really good to be able to measure against bank interest rates. So if bank interest rates are say 5% and you're getting a yield of 7% on your shares, it means your shares are a good investment. When you first look at shares, sometimes you'll hear the term par value. The par value is the value of the shares when they were first floated. Now this might mean that you had some shares floated when the company was first put on the share market for $1, and suddenly the demand grows and pushes them up, so they might now be worth $4. But the par value is what they were originally worth. The market value is how much they are worth and trading at now, and that depends on market demand. A rights issue is sometimes offered by a company to generate more capital. And a rights issue means that you might get shares at a discounted rate at a pro rata basis, which basically means that if you've got, say, a 1-for-4 rights issue, it might mean that you, for every 4 shares you own, you're allowed to get 1 share at a discount. There are some other rules around these as well, but generally it's a good way of increasing your folio or your portfolio and the number of the shares that you hold because they are at a cheaper price. The paid up capital of a company is how much money the company first raised when they were floated on the share market. So if you had 1,000 shares in your company and you floated them at $1 each, it'd be 1,000 times by $1. It means that you've raised $1,000 for your company. Those people who bought the shares become shareholders and part owners in your company, but the money is yours to use and develop your company. Now you've got to go through a whole lot of rules and regulations before you list your company on the share market, but generally that's how it works in terms of paid up capital. When you own shares, you can make an income from them in a dividend. A dividend is the distribution of profits by the company to shareholders. It normally comes to the preference shareholders first and then the ordinary shareholders. It is often expressed as a number of cents per share or a dividend per share. And sometimes companies pay them twice a year. They have an interim dividend in the middle and then a larger final dividend at the end of the year. A franked dividend is a dividend where the company has already paid tax on that dividend. Otherwise, you have to pay full tax on it at your current rate. So a franked dividend is one that's been paid, had some of the tax paid on it by the company at the company tax rate. And we'll explain that later in the course as we go through. A capital gain is another word for a profit. So if you buy shares and sell them for higher than what you bought them for, you make a profit, and that is called a capital gain. And the opposite of this is a capital loss. If you have shares that have made a loss, you might have bought them high and sold them low, and you make a loss, that is called a capital loss. You might have heard the term capital gains tax. Capital gains tax is the tax that you pay on any profit. So therefore, if you buy shares for a low price and sell them for a high price, you'll have to pay capital gains tax on that profit because that is a taxable income. You may have heard of the thing called the All Ordinaries Index or an index number. And an index number is a measure in the change of value of a group of assets or a group of shares. So it's just a number that measures the change in value. So the All Ordinaries Index, or the All Ords, is an index performance of all the about 500 companies in the Australian share market. So basically this will show you as a snapshot of whether the share market is travelling higher or lower, or how it is performing. It's an index number. It's not the value of the shares, it's just an index number, so it indicates what is happening. The American market, or the Dow Jones Index, is the American version of the All Ordinaries Index. And this shows us how the US market is travelling. There are index numbers for all major shareholders around the world, and they all have different names. The last few terms have got to do with kind of like how the market's performing. If the market is going really poorly and it's dropping, it's sometimes referred to as a bear market. And you can imagine a bear pulling down prices, or pulling the bark off a tree. Bear pulling down things, it's down. It means the price is going down. The opposite of a bear market is a bull market. This is where the shares are being pushed up, and they're generally rising, and there's the long-term kind of outlook is that there are going to be more rises on the horizon. So that is a bull market. Liquidity. Sometimes people talk about shares being a good asset because there's high liquidity. This is the measure of the ability to be able to buy or sell the shares easily with a little impact on the overall price. So if shares are trading very fluid, it's because high liquidity is happening, and this means that shares are trading a lot, but the share price isn't moving up or down very much at all. So that is the end of this short screencast that shows you or tells you about some of the terms used in the share market. It's always worthwhile going to the Australian Stock Exchange site to look at their glossary of terms, for they are far more detailed than mine are.